All right, so here we're going to be continuing on with our study guide. Okay, question number 27, chapter 7. So let's take a look here. Question 27 asks, okay, that your tracking method is perpetual. And if on June 1st you made a purchase of coffee mugs for $2.35, so you purchased 100 of them, and freight costs you $100. You purchase this on an account, record this transaction. So we're practicing recording perpetual inventory. So how would you do this?
Purchase expense.
What tracking method are you using?
Perpetual.
Perpetual.
So be inventory.
It'd be straight into inventory. In this case, I specified what you bought. So you would have to say either inventory or coffee mugs. Uh-huh. Right? And what else?
Sales.
Not sales, we purchased.
Oh. Is it freight? No.
No freight.
Um,
Freight's going to be included in the overall price. There's no tax.
Oh yeah, because
Yeah, because we're purchasing.
I remember this one.
So how did I buy it?
Oh, okay. It says made purchase on an account. So checking.
Not checking. What happens when I said I buy it on an account?
Account. So it would be account payable.
Correct. So because in this case, right, I owe this vendor money because I paid on it on an account. I have an account with them and say, hey, charge it on my account. Okay, so that means I owe this vendor money. Now, I bought 100 of these coffee mugs at $2.35 each, and the freight was $100. So what's my total amount of inventory and the total amount that I owe?
Okay, so it's 235 times 100.
100.
So it would be a total of 335.
Correct, right? Because in this case, I'm going to find the price of my inventory, which is the 235, right? 235 times 100 gives you 235. And then I have to add my freight in there because everything's going to go into my inventory. So therefore, it should be 335. Good. Okay. If, question 28, on June 7th, you received your coffee mugs and found two of those coffee mugs were cracked. Okay? And of course, you requested for a full refund from your vendor. Okay? Record this transaction.
So it would be coffee mugs.
Are you increasing or decreasing?
Decreasing.
We're decreasing, so that would be the second thing that you're going to recognize. Okay? What's the first thing you're going to recognize?
Purchase, return, and allowance.
Okay, not a purchase returns allowance. That's for periodic inventory. When you have an expense, you can't undo an expense, right? We've mentioned this yesterday where, for example, rent expense. Can you undo a rent expense?
No.
No. So that's why you need to create a contra account. In this case, right, inventory is inventory. If we're constantly putting stuff in inventory, you can constantly take stuff out of inventory. That's perpetual inventory, and that's what you've already done. Now, in this case, right, we recognize the return on the items. What about how did I get my money back?
Accounts payable.
Correct. In this case, right, I never paid this vendor. So if I never paid this vendor, it's going to decrease what I owe them. Now, how much do I owe them? If in this case, I'm making a refund for 2 of those broken coffee mugs, assuming that these are all connected. How much did it cost me per coffee mug?
It would be $4.70.
Good, right? $2.35 times 2, right? $2.35 is what I purchased it for. Times 2 will give you $4.70. Good. You returned 2 items at $2.35 each. Okay. Number 29. Okay, if on June 8th you sold 25 mugs for $10 each, and if it cost you $3.33 each, okay, assume no sales tax. So all sales were made with cash. So how do I record this transaction here? If I sold 25 coffee mugs for $10 each with no sales tax, and they were cash sales.
Coffee mugs.
Coffee mugs. Okay, so first, you need to sell the product in order for you to update it.
Okay, so sales.
We need to recognize sales. Now, before we do that, right, so we have sales. What else do we need to recognize? How did I get paid?
Cash.
We got paid in cash. Good. And there's no sales tax, right? So in this case, what was my total amount of sales?
$2.50.
$250, right? 25 times 10 gives you $250. Since there's no sales tax, that's the exact amount of money you're going to be collecting. Now, because this is perpetual inventory, right? We also need to update my inventory because I'm constantly updating it. When I make a purchase, I update it. When I make a return, I update it. When I make a sale, I need to update it. So in this case, how are you going to represent that you got rid of your inventory?
Coffee mugs.
Coffee mugs, okay, so that's what you're going to recognize. You're going to credit because you're decreasing your coffee mugs. And what account are you going to use to represent that you sold the items?
Cost of goods sold.
Cost of goods sold, right? You need to figure out how much it cost you to sell these items. Okay, cost of goods sold. So in this case, if each coffee mug cost you $3.37, how much is your total cost of goods sold?
$84.25.
$84.25, right? Which is going to be $3.37 multiplied by 25 cups will give you your $84.25. 27, 25.
25.
Okay, perfect. Okay. Good. Okay. If on question 30, if on June 10 a customer returns 2 of those coffee mugs for a full refund, you sold each coffee mug for $10 each, and these coffee mugs cost you $3.37 each, record this transaction. So a customer decides to return.
Sales return.
Sales returns and allowances, good. Because a customer is returning, right? They are returning sales. Since we didn't charge any sales tax, no sales tax. How am I going to give back the money to the customer?
Accounts payable.
Not accounts payable. They didn't owe me money. Or I don't owe them money. That's what accounts payable is. How did they purchase it in the first place?
Oh, cash.
Cash. Good. So that's why I'm going to give them back their cash. Right? So if I sold 2 coffee mugs at $10 each, how much is their total refund?
20.
$20, right? Good. 10 times 2, no sales tax, so $20. I'm giving them $20. Now in this case, since they're giving me back my product, I need to update my inventory once again because this is going to go back into my inventory.
So, coffee mugs.
Coffee mugs, okay? And what else?
Cost goods sold.
Yes, excellent. Cost of goods sold. In this case, because I sold it, right? And I calculated the cost of goods sold, right? If a customer decides to return something, I have to undo the cost of goods sold because I didn't sell it anymore. I have to put it back. So therefore, I need to put the cost of goods sold back. Now, if it cost me $3.37 and they're returning 2 of them, how much am I going to be putting back into my inventory?
$4.70.
Not $4.70.
Oh, it's not the same price. Okay. $6.74.
Okay, because it cost you $3.37 each, and you're returning those 2 products back into your inventory. It's gonna cost you whatever 2 times $3.37, which is $6.74. Good. Excuse me. So let's practice actually calculating your inventory, okay? So important information you need to know here is your tracking and costing method is perpetual, but this time it's LIFO. Okay? So we're going to use this table to answer the next 2 questions. Okay? So on June 1st, right, we purchased 100 toys at $1 each, okay? And the freight cost you $25. So June 1st, we're going to skip over the cost of goods sold. We purchased 100 toys at $1 each with a freight of $25. So what is going to be my purchase price?
100.
Plus 25
$125.
gives you a total cost of $125. And because this is LIFO, I have to keep my batches separate, right? So what's my cost per item going to be?
$125.
$1.25. Okay. So then on June 10, you end up making an additional purchase of 200 toys that cost you $1.25, and the freight cost you $50. So June 10, we purchased 200 units at $1.25 with a freight of $50. So what's my purchase price here? $250 plus 50
$300.
gives you a total cost of $300. I still need to solve for my cost per item.
$150.
It's going to cost me $1.50, right? Take my 300 and divide it by 200. I get $1.50 each. Okay. So then here on June 12th, we end up selling 200 toys for $5 each. No sales tax was charged. So in this case, right, I end up selling on June 12th 200 toys. So using the rules of LIFO, last in is first out, which batch of inventory am I going to take out from?
The 200.
we're going to take out from the last batch of 200 at $1.50, which we already know since we're going to get rid of the entire thing. That cost me $300. Okay? So then this whole entire thing's wiped out. Okay? So let's see what's next. Okay? Then on June 15, you end up purchasing 300 toys at $1.50 with the freight costing $75. So, June 15, we purchased 300 units at $1.50 and the freight was $75. So in this case, what's my total purchase price here?
$4.50 and $5.25.
And cost per item?
$1.75.
Okay. So now I have two batches of inventory, right? I have my first one for 100 at $1.25 and I have 300 at $1.75, right? The 150 was completely gone. So then let's see here. On June 20th, you end up selling 250 toys at $1 each with no sales tax. So in this case, I just sold an additional 250 units. So how do I pop this in here? So it's June 20th. I sold 250 units. Using the rules of LIFO, which batch am I going to dip? Which one am I going to sell out first?
$4.50.
$4.50. That's how much I have of the
300.
the 300 batch, right? Because it's my last batch that I just purchased. So therefore, these ones are going to go out first. So in this case, what's the cost per item since I'm not going to take the whole batch?
$1.75.
It's going to cost me $1.75. So what's $1.75 times 250? $437.50. So minus 250. Okay, you should have a total of 50 units left at a grand total cost of
$87.50.
right? Good. So then it tells you here that on June 30th, you had a total of 150 toys left. And let's calculate this. So let's call this the total. Okay? I guess we could do tote. Okay? So let's take a look. How many total items did I sell?
$4.50.
We sold 450, which cost me a grand total of
$737.50.
Okay, good, right? And I have a total of 150, right? I have the 100 from the first batch, and I have a remainder of 50 from the very last batch that we purchased. So therefore, that's 150. What's my total cost? If my first batch was 125 and I have a remainder of 87.50, what's my total cost of my inventory on hand?
$212.50.
Okay. So let's go ahead and double check my answers. So question number 31, okay? What is the total cost of your ending inventory on hand? So the balance of 150. What did it give me?
$212.50.
$212.50. What was the total cost of your cost of goods sold? $737.50. Okay. Good. All right. All right, so let's do another example, but this time my tracking method is moving average. Okay, so I can't copy and paste this one because it's perpetual inventory. It's going to look different. Okay, so I have to go through it one at a time because every transaction affects the overall inventory. So let's take a look at the first one. Okay, first one is June 1st. I purchased a total of 100 toys, costing it $1 with a freight of 25. Okay, so that one is the same, right? So we have June 1st, purchase a total of 100 toys at $1, which gave you 100 plus 25 gives you 125, which we already know this cost me right now $1.25 because it's the first batch of inventory. Assuming this is the only batch of inventory, it's going to be my average cost is $1.25. Okay. So then June 10. June 10 rolls around and we purchase 200 units at $1.25 with a freight of 50. So in this case, what's my purchase price here?
$250.
Okay, plus 50.
$300.
Okay. Now, I'm using moving average. What do I need to do?
Do I need to calculate a new cost per item?
You do need to calculate new cost per item, but in this case,
It's with both of the purchases.
correct, right? It needs to be a combination. So in this case, what's my total amount of items that I purchased?
300.
Right? You need to add these up. I don't know why I can't. Okay, so 300, right? There you go. 300. Okay? And what's my grand total purchase price?
$425.
Okay? Giving me an average cost per item to be. So 425 divided by 300, my average cost per item is going to be
1416666.
okay, good. So then here it says June 12th, you end up selling 200 units. Okay? So June 12th, we sold 200 units. What's my average cost per item right now?
1.416667.
Good. So therefore, I need to calculate what my total cost of goods sold is for selling 200 units at $1.416667. So in this case,
283.3333.
okay, $283.33. So therefore, I need to subtract that out. So 200 will leave me 100. Okay. Minus 283.33. So what should I have left remaining?
141.6666.
Okay, or 67 because you have to increase it, right?
Right.
Okay. So therefore, that's my new value right now. So that should still give me $1.4167, right? So then let's see what happened next. On June 15, you end up purchasing 300 toys at $1.50 with the freight cost of $75. So June 20th, I purchased 300 units at $1.50 with the freight of $75. So what's my total purchase price here?
For the last one, did we take it out already?
Yeah, we have 100 left.
Oh, okay.
Right? 300 minus 200 gives you 100 left. I don't know if you want me to highlight this or not.
No, it's okay. And then we just purchased 300.
And we just purchased 300.
Okay, so 300 times 150, 450,
Plus 75.
525.
Okay. So now I need to calculate my new average cost per item. So how many items do I have in grand total right now?
400.
What's my total purchase price?
666.67.
Okay. So what is my average cost per item now?
1.666675.
1.666675.
Mm-hmm.
Perfect. Okay. So that's my average cost per item. So the last one says here that on June 20th, we end up selling 250 units. Okay, so June 20th, we sold 250 units at $1.6666, so on and so forth. So what's my total cost of goods sold here?
416.67.
Good, 416.67. So therefore, if I subtract that 250 at 41667, right? What's my ending balance going to be?
150.
I have a total of 150 left at a grand total cost of
250.
okay. And let's also solve for my cost of goods sold. Or yeah, my cost of goods sold. So how many items did I sell?
450.
At a total cost of $700, right? You're gonna add these two up together to get a total of $700. So let's answer the question. What is the total cost of your ending inventory? Which in this case,
250.
250. Okay. And what is the ending ending balance of or your total cost of goods sold?
700.
700. Good. Okay. All right, so that was the second method. Let's complete the third method. Actually, wait. Okay, yes, because FIFO, right? You're just going to do the same thing except instead of calculating the last one, you're going to calculate the first one. All right, so very similar. Okay. All right. Moving on to the next one. Okay. So we're on chapter 8 now. Okay. Use the following information to answer the next question. So, if on January 1st, right, you establish, oh, we're on chapter 9. If on January 1st you establish a petty cash fund, okay, for $500, right? By January 31st, you counted all of your receipts. So here what you bought. You bought a birthday cake for $19.99. You bought pizza for $23.78. You bought office supplies for $6.02. And you bought postage stamps for $10.75. So, question number 35 says, okay, for what amount do you need to write a check for to replenish your petty cash fund?
B.
B, right? $60.54. So all you have to do is tally up the total of your receipts, right? Because in this case, right, this is how much money I spent out of my $500. If I have this much spent, how much do I need to put back into the petty cash drawer, right? You're going to calculate the total amount of your receipts and you're going to write a check for the total amount because you want to make sure that your cash box is equal to whatever you establish it at all times. So in this case, I need to have my box to be consistent with $500. If I spent $60.54, that means I only have 400 something dollars in my register or my lock box, right? I needed to have 500 at all times. That's what the idea here is. So good. You calculate all the total amount of receipts and they totaled up to be $60.54. Okay, good. All right. How do you establish a petty cash fund? A, right? You're going to debit your petty cash and credit your checking. Okay, let's take a look at the other answers. You're going to debit your checking and credit your petty cash. No, that's to close it. You're going to debit petty cash and credit all expenses. No, you're not. Okay? And then you're going to debit all expenses and credit petty cash. No, you never do that. Not even to replenish your petty cash fund. So A is correct, right? You're going to establish how much, right? You're going to debit your petty cash and it's going to come directly, the money should come directly out from your checking account. Okay, good. All right, so question 37 here. Okay, how do you replenish a petty cash fund?
B.
B, right? You're going to write a check for the amount of the total receipts in the lockbox from the petty cash fund. Yes, right? We just did an example, right? That's how you replenish a petty cash fund, right? All right, so moving on to chapter 10 here. Question number 38. Under which method do the IRS use to write off bad debt for tax purposes only?
B.
B, bad debt expense. No, it's not the that's not the method.
C.
C, direct write-off method. Yes, so that's the one I couldn't teach you because you're not a tax accountant, right? I had to teach you the allowance method because that's the proper way to do it for regular accountants. Okay, so for the IRS, you cannot use the direct write-off method because it's for tax purposes only. Okay. All right, question number 39. Okay, if a company estimates that $34,887 of its 500,000 accounts receivable is to be uncollectible, and there is currently a debit balance of $5,000 in the allowance for doubtful accounts, okay, the adjustment entry will be B, 39,887. Let's see. So in this case, right, what told you that you had to add these two numbers?
Accounts receivable.
Accounts receivable tells you that you're using the balance sheet method, which includes both accounts receivable and the allowance for doubtful accounts. Now, another thing too is there's currently a debit balance. You need to be on the left side, 34,000. You need to be on the right side, 34,887. Now, I'm already on the left side, 5,000. So how much do I need to go to the right side to get to my end goal of 34,000? So in this case, I need to backtrack 5,000 and then I need to add an additional 3,400, right? Or 34,000. So in this case, you're going to have your bad debt expense, okay, with the allowance for doubtful. And it's going to be the 39,887 because you're adding the two numbers together. Okay. 34 plus 5 gives you 39. Okay. So another example here for question 40. If a company estimates that 34,887 of a 500,000 total credit sales is to be uncollectible, okay? And there's currently a credit balance of $5,000 in the allowance or doubtful accounts. The adjustment entry will be A, 34,887, right? Because in this case, what indicated you to take the estimated number?
Sales.
Total credit sales means I'm using the income statement method, right? Income statement method. The word account receivable does not exist. So if it doesn't exist, neither would the allowance or doubtful accounts. So in this case, right, all we care about is just whatever the amount is in your total estimate. So in this case, 34,887 is correct. Okay, which is letter A. Okay, we don't care about what the balance is in the allowance for doubtful accounts because it will not matter. It will not affect it. Okay. What about 41? If a company estimates that 34,887 of a 500,000 accounts receivable is to be uncollectible, and there's currently a credit balance of $5,000 in the allowance for doubtful accounts, okay, then the adjustment entry will be C, right? 29,000, right? Because in this case, accounts receivable is going to tell you this is the balance sheet method, right? We're going to take the estimate, right? And since there's a credit balance in my allowance of doubtful accounts for 5,000, my end goal is I need to get to 34, but I'm already on the right side, 5,000. So in this case, how do I get from 5,000 to 34,000? I simply just subtract the two numbers and I should get 29,000. Okay. 29,887. Okay. And of course, last but not least, if a company estimates that 34,887 of a 500,000 total credit sales is to be uncollectible, and right now there's currently a debit balance of $5,000, then the entry will be
A.
Right, because in this case, we don't care about what the balance is because we see total credit sales. So we don't care what the balance is in my allowance for doubtful accounts. So it should be whatever the estimated amount is. Good. Okay. So here, for this question here, we're going to be using this following tables below to answer the next question. So here is a bank statement. Here is your cash ledger. Here is your check register, and here's your deposits. Okay? And here's the table. You need to do a bank reconciliation. So, the end goal here for question 43 says, what is the adjusted balance in the bank and cash ledger? So that's what we need to solve. We need to solve for this answer down below. Okay? So let's start. Which side do you want to do first? You want to do the bank side or do you want to do the cash side?
Bank.
Let's do the bank. So we need to start with the ending balance in my bank account. So let's take a look at my bank statement. So my bank statement tells me my ending balance is
$1,088.
$1,088. Okay? Now, in this case, what do I need to add to my bank? What does the bank not know that I know?
Deposits in transit.
Correct, right? The bank doesn't know that I deposited the money, right? So in this case, I'm going to put deposits. Okay, so let's take a look. So here's my deposits that I've made. I made a total of 1, 2, 3, 4, 5 deposits. And let's see, let's check on my bank statement. How many of them actually cleared?
4.
Only 4. So in this case, let's go through it. We got 360, 297, 284, and 126. So let's see. Okay. I have the 360, the 297, 284, 126. So which one is missing?
483.
483 is missing. Okay? So that's the only deposit I have that's missing on August 30th is 483. So So you're going to add $483 to your bank. Okay. What do you need to subtract from your bank? What does the bank not know that you know?
Like if you write checks that haven't been cashed yet.
Correct. We call those outstanding checks. So therefore, for bank side, you do, right? You do your deposits and then you have your outstanding checks. So in this case, I'm going to put O/S for outstanding. Okay? So outstanding checks is what you need to subtract from your bank. So let's take a look. How many checks did I write in my check register?
8.
You wrote a total of 8, right? 102, 103, 104, 105, 106, 107, 108. 308. Okay? So let's take a look. Which checks actually cleared on my bank statement?
We're missing 7.
We're missing 7. And what else?
And 6.
And 6, right? We're missing 6 and 7. So let's take a look in my register. So I'm missing 306 and 307. Okay. 306 was the total amount of 314, while 307 is an amount of 54. So 314 and 54. Okay. So 314 and 54. What is the total amount that I need to subtract?
368.
So let's go ahead and figure out this number, okay? You got 1088. You're going to add 483, and then you're going to subtract 368. 1203. Okay? So you're not done there, right? Because you could have a potential error here. So let's take a look on the cash side. Okay? What's my ending balance on the cash ledger? So here's your cash ledger, right?
$11.53.
That's correct. 1153 is what you have your ending balance in your cash ledger. Okay? What do you need to add? What does the bank know that you do not know?
Interest.
The interest that the bank collects for you, right? So this is for when you set up accounts receivable, right, to be collected via online. They can, since you can charge your customers interest on top of that, the bank can collect the interest money for you. So in this case, auto clearinghouse is also more or less the same thing here. All right. So we got auto clearinghouse for $125, and we have interest for $75. Okay. So you're gonna add $200 to this pile here. Okay. What do you need to subtract? What does the bank know that you don't know?
Fees.
They know that they charged you fees and they take it off of your bank account immediately. They don't even notify you. So let's take a look on your bank statement. How many fees was I charged?
2.
2, right? You got one service charge for 100, and you had an NSF, so you wrote a check out that was faulty. They pushed it forward for you, and then it cost you $50. So, okay, so there you go. 4. Let's fill that in. So you got service charges. And you got NSF fee of $50. So in this case, I need to subtract $150. So let's take a look here. If I started with 1153 and I need to add 200 but subtract 150, what's my total ending balance?
1203.
1203. Okay, so that's my adjustment. And then do they match on both sides? Yes, they do. So what is your total ending balance? 1203. Okay. Question number 44. Okay. You bought a bank bond worth $200,000. Okay. Its annual simple interest rate is 7.75% and can be redeemable at any time. Okay? How much will the bond be worth in 10 years? So what am I asking you?
The worth of the bond 10 years later.
So is that future value or interest?
Future value.
Future value. So in this case, let's take a look. How do I solve for future value with a simple interest?
You do 200,000 200,000 times 0.075775 times 0.0775 times 10.
Mm-hmm. Simple interest is you're going to multiply all the numbers across.
155,000.
Okay? How do I solve for my future value?
You do 155 plus the 200,000.
Good. So that will give you a total future value of
355,100,000.
good. So let's answer the question. How much is the bond going to be worth in 10 years?
C.
C. 355,000. Okay? So let's take a look here. If a credit card company, okay, let you borrow $500 at a simple interest rate of 28.9%, okay, how much interest will be collected at the end of 2 years?
2890.
How did you figure that out?
500 times 28.9. Oh, I did something wrong. And then times 2. 28,900.
Okay, let's do it again.
Oh wait, no, that sounds even worse.
Yes.
So 500 times 0.0289.
Not 0.0 because it's 28.9%.
So it's just 0.289.
Not 0.289. Because in this case, what you're going to do is you see this 28.9%, right? To change this into a decimal, you move the decimal left by 2 spots. So in this case, 28% is going to be 0.28%. There's no 0 in the front of it.
Okay, so 0.289 times 289.
Okay? 289. Right? So the question here, what is the question asking you?
Okay, you are for simple interest. How much interest will be collected at the end of 2 years? So 289.
289, right? Because it's asking you how much interest, right? It's not asking you what the future value is. It's asking how much interest is going to be collected, and you said $289.
You're trying to trick us.
So make sure you read these very carefully because I will ask you exactly this way. I will ask you one of these 2 questions, right? How much interest will be collected in 2 years? And how much will the bond be worth in 10 years? So one of them is asking you for the future value, and one of them is asking you for the actual interest. So make sure you are aware of what you're reading and knowing exactly what the question is asking. Because I could mix the answers in there together. Okay? All right. Now moving on to chapter 11. So question 46. What fixed assets can never be depreciated?
B.
B, land, right? We saw this on our quiz. Okay. Number 47. Okay, if fixed assets are depreciated, then intangible assets are
A.
amortized, right? Good. Number 48, okay? If a machine was put into service as of January 19, when do you start depreciating?
C.
C, February 1st, right? Because in this case, it was less than 50% of the month, right? The cap is 15, right? So it had less than 50% of the month to be used. So in this case, you would just start depreciating it as of February 1st, the next month. Good. 49. GAAP determines what two components for depreciation?
D.
D, A and C only, right? Um they only have the estimated useful life, and they also establish the salvage value, right? So in this case, this one is a very specific. It says two components. Partial years is not determined by GAAP. Okay? So D is the correct answer. B and C only. Okay. Number 50. Okay? What are the three depreciation methods?
All of the above.
All the above, right? We did learn double declining, right? When we depreciate it in its beginning of its life, twice as fast, twice as much. Straight line is where we do evenly across its life, and units of production is based on capacity, right? I taught you all three methods. So in this case, D, all of the above. Okay. Number 51, under double declining method, at the end, book value must be equal to.
Under the double declining method at the end, book value must be equal to salvage value.
That's correct, right? You can never fall below salvage value. And that's not true for double declining, it's true for all of them, right? However, the one that you need to be careful most is double declining because you may not end at the end of the year. You may not you could go beyond its life of time, but you can also go under because you're depreciating it twice as fast. So the rule here is if there's a salvage value, you need to make sure that the book value does not fall below it. It must equal salvage value at all times. Okay, so good. Okay. So let's go ahead and practice this depreciation method. So using the table below to answer the next two questions. So here you bought an asset, which is a computer. The depreciation method that you're using is straight line. Its estimated useful life is 5 years. The asset cost is $2,500. The salvage value is 0. And the date that you placed into service is January 5th. Okay? So for year 1 and year 2, you need to solve for both of them because the question is going to ask you for number 52, what is the depreciation expense for year 1 and year 2? So let's go ahead and solve for this. So this is straight line. So how do I solve for the depreciation basis?
1 second. Let me grab my note.
No worries. I can pull up this as well.
Okay.
So we're on depreciation, which is, okay, straight line is this one.
Okay, so cost of asset minus salvage.
Mm-hmm.
And there was no salvage, so 2,500.
Good, right? My asset cost of 2,500 minus salvage value of 0 is going to give you 2,500. What's my depreciation rate for straight line?
1 over estimated useful life.
Mm-hmm.
So that would be 0.2, so 20%.
Mm-hmm. 20%. So what's my depreciation expense for the first year?
500.
500, right? 2,500 times 0.2 should give you $500. So then your accumulated depreciation,
That would be 2,500 minus 500.
that's your book value.
Okay.
So accumulated depreciation,
Previous year's accumulated depreciation plus current year's depreciation expense.
so in this
So
case,
500.
it'd be 500, right? Because there is no previous years, but the current year is 500, right? So what's your book value?
2,000.
2,000, right? You take your cost of the asset minus the accumulated depreciation of 500 will give you $2,000. Okay. All right. What about year 2?
2,000.
Not 2,000.
25.
2,500, because in this case, this one is using the asset cost minus salvage value. So asset cost of 2,500 minus salvage value of 0 is still going to give you 2,500. What's my rate going to be?
20%.
It's going to be the same as well. 1 divided by the estimated useful life will still give you 20%. So my depreciation expense is basis times rate.
500.
So it's going to be another $500. Now you have a previous balance plus your current. So what should be your accumulated depreciation for year 2?
1,000.
So therefore, what should be your book value?
1,500.
Good, right? You're going to take 2,500 minus the accumulated depreciation of 1,500, and you should get, or sorry, accumulated depreciation of 1,000 should give you a total of 1,500. So, to answer question number 52, what is the depreciation expense for year 1 and year 2?
500.
500. Okay? What is the book value of year 2?
1,500.
1,500. So these are the questions I could ask you. I can ask you, how much expense did you incur? What is the book value? So that's why you need to be able to exhaust as much as you can. Now, in this case, on the exam, I'm going to have it exactly like this, where I'm only going to test you maybe 1 or 2 years. Okay? I'm not going to have you do all 5 or all 7 or 15, whatever you want to see. I want you to just be able to just calculate the first 2 years. Okay? Right? So let's go ahead and do the next one here. Use the table down below to answer the next 2 questions. Okay? This time I bought a printer, right? And I'm using units of production. Okay? That's at the number of units that this printer can produce is 10,000 pages, right? And the asset cost is 500. Salvage value is 0, and the date that you placed in the service is January 2nd. Okay? So what is my depreciation basis going to be for units of production?
Cost of asset minus salvage.
Okay, so in this case, what was the cost of my asset?
500.
Minus salvage value of 0. My depreciation basis is going to be
500.
good. What's my per unit rate going to be?
So, depreciation basis, estimated units produced.
Okay. So
it'd be 500 divided by, where is it? 10,000.
10,000. Good. Correct. Right. You want the entire capacity of how much this product can produce. Because what we're determining here is how much is it going to cost me per unit. Right. So in this case, per page. How much is it going to cost me per page?
I got 0.05.
Good. It's going to cost me 5 cents per page. So then for the first year, if I produced 2,500 pages, what's my depreciation expense going to be?
125.
2,500. Good. 125. That's going to be 125. So what's my book value going to be?
375.
Right? You're going to take the cost of the asset of 500 minus your accumulated depreciation of 125 to get 375. Okay? Let's go ahead and solve for year 2. What's my depreciation basis going to be for year 2?
500.
Right? It's still going to be asset cost minus salvage value, which is going to be 500. My per unit rate,
5 cents.
it's still going to be 5 cents because it's still 500 divided by 10,000 gives you 5 cents each. But this time, I produced 2,000 pages for year 2. So what's my total amount of depreciation expense?
100.
100, right? 2,000 times 5 cents gives you 100. So what's my accumulated depreciation?
225.
Right? You got your previous years of 125 plus 100 current gives you 225. So what's my book value now?
So it would be 500 minus 225.
Mm-hmm.
275.
275. Okay, good. So let's see what question 54 says. 54 says, what is the depreciation expense for year 1?
125.
125. Okay, make sure it's very specific. Okay. And then question number 55 says, what is the book value for year 2?
275.
275. Good. Okay. Last depreciation method for today. Okay. Use the following table to answer the next 2 questions. This time we still bought a computer, and this time the depreciation method we're going to be using is double declining. Okay. Estimated useful life is 5 years. Its asset cost is 2,500, salvage value 0, and the date that we placed into service was January 5th. So for this case, what is the depreciation basis for double declining?
It's the book value.
Mm-hmm. So what's my current book value for year 1?
The asset cost.
Correct, right? In this case, we haven't depreciated yet. So in this case, it's going to be the cost of the asset. So 2,500. Okay? What's my rate going to be?
1 over life times 2.
Mm-hmm.
So it would be 1 divided by 5 times 2. So it'll be 40.
Good. Okay. So then what's my depreciation expense for the first year if it's basis times rate? Okay, so 2,500 times 40%,
1,000.
$1,000. Okay, so therefore your accumulated should be 1,000. Okay, so what's your book value for year 1?
1,500.
1,500, right? You're going to take your cost of the asset of 2,500 minus accumulated of 1,000 will give you 1,500. So then, what is the Depreciation basis for year 2.
1,500.
1,500, because this one, right, it's the beginning of the year's book value. If at the end of year 1 is going to be 1,500, then that's going to be the same as the beginning of year 2. So in this case, this is the one where you carry the book value over. So 1,500. Now what's my rate going to be?
40%.
Good, right? It's still going to be the same. 1 divided by estimated useful life times 2, which is 40%. So in this case, what's 40% of 1,500?
$600.
600. Okay? So what's 600 plus 1,000? 1,600. So therefore, what's your book value at the end of year 2?
900.
900. So in this case, right, you take your asset cost of 2,500 minus your cumulative 1,600 to get you 900. So in this case, 36 asks, okay, what is the depreciation expense for year 1? $1,000, okay? And what is the book value for year 2?
900.
900, okay? So once again, this is, you need to know the difference between the 3 methods, okay? And I could ask you, what is the book value for year 1? What is the book value for year 2? What is the depreciation expense for year 1? Depreciation expense for year 2? I can ask you anything, right, in regards to this table, okay, for all 3 methods. So, any questions in regards to the study guide?
No.
Okay.